Welcome back to Primary Source China Investments. Peng Guo and I are here for show U4. And this week, we're going to talk about IPOs. And Chinese companies are still listing in the US, and we have some data to back that up. Although they're listing in the US, that doesn't necessarily mean they're performing in the US. So we've talked a lot about this idea that Chinese companies that are listed in the US are migrating back to Hong Kong or the mainland. And we've talked about this from large SOEs like PetroChina, Sinopec, China Life, but also which made a lot more headlines were the tech companies like Alibaba and Baidu. And while there was an agreement last August between Chinese and US regulators, this story is continuing to evolve. But let's look what happened this year. So far this year, there's been 14 mainland companies listed in the US. And since we follow investment and policy, we're tracking performance. Recall what we've been saying on this show for a long time. Buy mainland stocks that benefit mainland consumers. And we've preferred A shares to Hong Kong listed or US listed stocks since the beginning of the show. So I can guess you know where this is going. But before that, Peng Guo, what's your feeling about the IPO market in general, both in the US and in China?
I think IPO market is the most profitable area. The problem
for
is
mainland market, for mainland in the
yeah,
mainland.
for mainland, for mainland is absolutely. Is mostly can treat it like the risk-free return. The only problem is you cannot have a chance to get invested. So they have to use a lot of ways to decide who can get the shares to the public.
You don't get the allocation, right?
That's right. That's the only problem.
Yeah,
so,
I think that's been a story for 20 years now.
That's right. And I think even for the Hong Kong IPO is still pretty good. But things get changed, I believe, since the 2020, after COVID started. So like the IPO started get a negative return, and the people start to see the risk.
So on the mainland, Shanghai, Shenzhen have seen about 65 IPOs this year. The worst performing one of those 65 was down 13%. So almost all of them have been up. Some have been up, consecutively, like you say, every day, 10% for a long period of time. I wanted to draw the attention to the 14 names that have been listed in the US because Chinese firms are still listing in the US for some reason. I can't quite comprehend why that is, probably liquidity for the owners, but year to date, in the US, there's been 50 IPOs, and Chinese companies represent 14 of those. So let's look at how those have performed. Here's a chart of the 14 names if anybody wants to go pull those charts. But let's compare the returns of the Chinese companies and returns of the non-Chinese companies. We'll put them in two buckets because in the non-Chinese bucket, there's some Singaporean, there's some Israeli, there's some even Thai, there's a bunch of different companies, but the 14 Chinese companies have returned negative 19.33% year to date. Compare that to the 36 other companies that have returned positive 16.97% year to date. And that's assuming you get the IPO price, right? Because, in the US, it's similar. You can't always get the IPO price. Further compare these Chinese IPOs to ASHR. Remember what ASHR is. That's the CSI 300. Those are the A share stocks. ASHR is up 6.4% year to date. Now let's compare that to the beta market, which is the S&P 500, which is up 7.9. And then the worst comparison is the Chinese tech companies listed in the US and Hong Kong, which is KWEB, which is the punching bag that we've used. That's down 4.3%. So the worst China equity allocation year to date has been Chinese stocks going public in the US. And the best has been the boring ASHR. So with all that data, and we'll put up screens and stuff like that, but Peng Guo, what's your thoughts about all of that?
A couple of things. I think firstly, as we know, like every country have the home country bias. So any Chinese company, they should get the highest valuation in China. There's still many reasons for them to into the United States. However, I think most of the Chinese companies, due to the small cap, some of middle cap, is not pay attention by the mainstream institutional investors. And secondly, China sector rotation, so it's pretty clear. This is like the investment style. I think right now, China is focused on like the tech-related area. So after it's getting down, probably like the traditional market, traditional stocks will get up. So whatever, you see the money flow out from like the new energy, new tech, or manufacturer companies. That means the traditional companies probably get up. So it's quite clear money rotated in the different sectors.
Well, you bring up a number of good points. And the first point I wanted to emphasize here that you said is there's a home country bias, and that's absolutely true. A lot of these Chinese companies would not be able to list in Shanghai and Shenzhen. You know, they have this new registration-based system for mainland listing, and these kind of companies would not pass the qualifications to list on the mainland. So they list in the US to get liquidity. And
yeah,
also,
that's another good point. Yeah.
Yeah. So that goes to your home country bias, you know, point. There's a lot of US investors that are looking at these names and saying, why do I want to own them? I have no reason to own them. Whereas the IPOs in China, they do have, you know, it's ironic to say, they do have more rigor. These companies have to be profitable for a number of quarters. They have to have minimum size. And just this past week, which was the most successful week in 18 months on the mainland, 10 companies went public, all of them up, average up 48%. So it's been a huge month for IPOs on the mainland. And I think that goes to this idea of home country bias. And like we said earlier, it's been 20 years. You buy IPOs, if you get the allocation, you generally make money.
That's absolutely right. That's why people have so much motivation to push the companies go to the public.
Yeah, it is ironic that you mentioned that it may be considered the risk-free rate. So it seems counterintuitive where IPO equities become the risk-free rate. But back to our original thesis, Chinese stocks listed in the US did not do well. They are the worst performing Chinese equity asset class. So the point that we've been pounding the table, if anybody's been listening, is if you're going to buy Chinese stocks, you should buy them on the mainland, and you should buy them with a focus for the Chinese consumer.
Yeah, another big point is think about what's the base for those public companies. So the non-public probably get 30 or 50,000 or maybe much more.
Yeah.
And then that, and opening right now, public, there's almost 4,000 companies. If you don't, your competitor get a public, that really means it's a disaster for you. So that's why.
Absolutely, absolutely. And companies do face this competition. Well, we're going to leave it there for show U4. Thanks for tuning in, and we'll see you next week.
Thank you.